You're listening to Simply Put, a podcast from FHN Financial. I'm your host, Will Compernal. The economy has managed to survive more than 4 years of pandemic disruptions, high inflation, and aggressive Fed tightening without going into a recession. The surprising resilience has left many to rethink the explanatory power of the models the Fed and most economists use. Today's episode is a live recording with Chris Lowe, Chief Economist with FHN Financial, and Thomas Coleman, Senior Lecturer at the Harris School of Public Policy at the University of Chicago, from Morgan's on Fulton in Chicago. We discuss why the recession that everyone felt was always 6 months away never happened, how to think about inflation for the next cycle, and the power of fiscal policy to drive the macroeconomy. Stay tuned. Coming up soon, our live recording with Chris Lowe and Thomas Coleman. But first, a quick market update. Today's employment report showed payrolls grew only 12,000 in October and the unemployment rate was unchanged at 4.1%. Hurricanes Helene and Milton, along with strikes at Boeing and with East Coast dock workers, caused labor market disruptions that, for now, may or may not be temporary. The Fed will likely look past the fog of this morning's report and prefer to use the September data as the more reliable gauge of labor market strength. Earlier this week, the third quarter GDP and September PCE came in mostly as expected. The economy grew 2.8% in Q3, supported specifically by strong consumer spending. The core PCE deflator rose 0.25% in September, in line with a consensus estimate and still low enough to give a quarterly annualized inflation rate of 2.2%. Broadly speaking, the economy is at low risk of a recession, and inflation is improving sufficiently in order for the Fed to keep cutting rates. The Treasury market over the last 2 weeks has added more bearishness to the sell-off that followed the September employment report at the beginning of October. Market pricing shifted decisively away from expecting aggressive Fed easing over the next 12 months, and is now consistent with the Fed's communication in our own forecast for the economic trajectory. After 5 consecutive months of positive total returns on treasuries, October ended as one of the worst months for bonds in the past few years. The 2s10 spread has continued to steepen with additional signs of economic strength. Running in parallel, some betting markets and forecasting models have suggested rising odds of a red sweep next week, leading some to draw a connection between that electoral outcome and higher deficits as a reason for the gradual rise in Treasury yields. We're hesitant to draw a straight line between the two just yet. The switch from models predicting 51% to 49% odds of a Harris win is not significant enough from a 51% to 49% probability of a Trump win to meaningfully explain the October bond market. Also this week, Treasury announced no change in the sizes of its coupon auctions for the next 3 months. The news was widely expected, leading to no noticeable bond market reaction. The press release also says Treasury expects to keep auction sizes unchanged for the next several quarters, suggesting any increases in the issuance of longer-term treasuries will wait until a new president is settled into the White House next year. That's all for the market update this time. Now our discussion with Chris Lowe and Thomas Coleman. Welcome everyone to the first live recording of the Simply Put podcast. I'm macro strategist Will Compernal. We're here at the wonderful Morgan's on Fulton in the West Loop in Chicago. And I'm joined by 2 guests today for our talk on the macroeconomy. First, we have Chris Lowe, Chief Economist at FHN Financial and frequent Simply Put guest. Chris, welcome.
Thank you, Will. Good to be here.
And then our special guest is Thomas Coleman, who's a senior lecturer at the Harris School of Public Policy at the University of Chicago. He previously had 20 years in the financial industry and is author of the book Quantitative Risk Management, and also, I believe, has another book coming out soon. So welcome, Thomas.
Well, thank you very much. Yes, and working on estimating U.S. Treasury yield curves from 1925 to the present.
Very pertinent to this crowd. Unfortunately, I know there were promises earlier today that we would tell you exactly where Treasury yields were going to go. We're going to give you a ballpark idea. Where we are right now in middle of October 2024, I think if there's any time to look back on what you might call the pandemic economy, it's now. The Fed started cutting rates last month. The November elections are in a few weeks, so no matter what happens, we'll have someone new in the White House come January. Chair Powell's speech at the Jackson Hole Symposium in August, I really felt like he was recapping all of the bumps and hiccups of the pandemic economy, Fed tightening and all of that, and felt like we were saying goodbye to a quite volatile period in the macroeconomy. So Chris, I want to start with the question to you. Inflation has come down without a recession right now. I know it's not exactly at 2%, but if you go back to the beginning of 2023, if you polled CEOs, 99% of them thought that a recession was coming. People on the Fed research staff thought a recession was coming. It seemed like it was just a foregone conclusion with Fed tightening and all these different headwinds that were happening to the macroeconomy. Looking back, what do you think was the main thing people got wrong? How did we get to this point where inflation got this low without the unemployment rate spiraling upward?
Well, I think there were several things that weren't necessarily well understood at the time, but we see now. One of them is immigration, which had a huge impact on the labor statistics, but isn't measured very well by the federal government. So you sort of have to go back and readjust and rethink, particularly when you're looking at the number of people employed, when you're looking at the number of people in the labor force. That is probably understated, and that put some pretty significant downward pressure on wage growth. Wage growth topped out at 6.2%, and right now it's just above 3.5%. So that's come down a lot, and in particular when you look at unskilled workers. When you look at the lowest paid workers in the labor force, which always, you can go back 40 years, they will be the ones enjoying the fastest wage growth until the last 3 years when they've really been compressed because, of course, most of the millions of immigrants coming in are unskilled and are competing for those jobs. I think that's a really important piece of it. In terms of how we avoided recession, I think the biggest thing is fiscal policy, which is behaving differently in the last 5 years than it did in the previous 45 years. We have continued to run really big deficits, even as the economy came out of recession and it started overheating, we continued to run very big deficits. And I think that is a piece that the Fed in particular tends to tread very cautiously around. They may be aware of it, they don't like to talk about it.
Thomas, I want to ask about that surprising economic resilience with a particular focus on monetary policy. So inflation got high in April of 2021, and the Fed didn't hike rates until March of 2022, and the Fed funds rate went up 525 basis points in a short period. They had their last rate hike in July of 2023 and paused for over 12 months. Now, most models, certainly the models that the Fed was using, would suggest that the economy wouldn't be able to withstand that. And as I look at it, inflation did come down, but it wasn't even in the most interest rate sensitive sectors. So do we look back on these last 4 years and should we rethink monetary policy?
Well, thank you. First of all, let me thank you and thank all of you for joining us. I actually think there are fundamental issues that we need to rethink concerning monetary policy. And the effectiveness of monetary policy. The economic resilience that we saw in 2023, 2022, it's only really one piece, I think, of a broader range of evidence. So, let's think of the end of the pandemic inflation in 21-23. As you said, the Fed did not raise rates until well after inflation had taken off. And most importantly, inflation started to fall even without the Fed raising rates. Inflation was coming down by the time the Fed started raising rates, and by the time rates rose up above inflation, it was more or less over. So this evidence, I think, is really sort of contrary to what we think about with sort of standard monetary policy. And we also have to ask, why did inflation take off? There's lots of stuff about supply chains and so on. But it certainly was not because of low interest rates. Interest rates had been low for a long time. And I really think we need a new approach to monetary theory. A more convincing story, I think, about the inflation and having to do with the falling inflation in 2023 was that the government borrowed a huge amount in the pandemic. It was $5 trillion of debt. $3 trillion of that was monetized. It was checks sent out to people, to businesses, to support people, to support the economy. And there really wasn't much talk about how it was going to be repaid. Budget rules were suspended. It really was, going back to sort of Friedman's quantity theory, a perfect helicopter drop of money and fiscal into the economy. So, as I say, I really think we need a new monetary theory. And there have been a group of economists, Eric Leeper, John Cochrane has been working on this a lot, that's developed a new theory, fiscal theory of the price level. And I think it does a much better job of explaining and helping us to understand what happened with the takeoff of inflation and what happened with the falling inflation. And this theory talks about the balance between government liabilities on the one hand and the surpluses, the future surpluses that we all expect to pay off those liabilities. The liabilities are money and bonds, and the future surpluses are the tax revenue that the government can extract from the economy to pay us all back. What happened in 2020? Huge increase in those liabilities, and not that much promise to pay that back. And so kind of under this theory, under the fiscal theory, what does that say? It says you gotta have prices going up to deflate away that debt. But once that debt gets written down a little bit, somewhat, then inflation tails off. So I think it's a really good story for what happened with the takeoff of inflation in early 2020 and 2021, and also with the falling. But you'll kind of note that it doesn't talk very much about Fed interest rates. So I'm afraid this is a somewhat heterodox theory at the moment, but I think it is the correct theory to think about monetary policy.
I think it is interesting, though, because a lot of Fed models, Chris, as you pointed out, fiscal policy was this neutral force there, and so they didn't even incorporate it. And suddenly, when you have $5 trillion of stimulus spending over 12 months, well, something is probably going to happen from it.
One of the things I think about, just from a personal point of view, right? I got my first job as an economist in 1987. And in that period from 1987 until the pandemic, most of the time, fiscal policy was just a little bit restrictive. It's because of sort of modern budgetary rules that were put in place by Graham, Rudman, and Hollings, people who, we've sort of forgotten about, but who transformed the way public policy worked and then were abandoned in the last 5 years. And because of that, I started talking about crowding out with a group the other day. This was something that in the early 80s when I studied economics, we all learned and we all talked about, and no one in the room, and these are all financial professionals, nobody knew what crowding out was. And the idea is Congress doesn't care, right? They don't care what rate they pay to borrow. If they're going to spend, they're going to spend, and they'll borrow at whatever rate they get. So there is this additional piece, too, that if the Fed is tightening to fight inflation, as long as the federal government is spending like that, they're going to have to tighten enough to make people in the private sector cut back enough to offset the excess in the fiscal sector. I think fundamentally this is something we as investors, people in an interest rate sensitive job, we need to start paying attention again, because effectively the brakes that have been on the fiscal sector for 4 or 5 decades are gone. Whether they may come back, which personally I think would probably be a good idea, but so far I don't see any promise of that.
Outside of that fiscal aspect of the last 4 years, returning to my original question, is it possible that the economy is just less interest rate sensitive than it was 30 or 40 years ago? Because again, the alignment in the economy, the better harmony between supply and demand that brought inflation down, it wasn't particularly in rate sensitive sectors. Again, despite Fed funds going up 525 basis points in under a year and a half. So is there a different kind of economy than those models are capturing, or is it really too hard to tell because there was so much noise during the last few years?
I think the effectiveness of monetary policy, and that's kind of what the question is about, I think has been kind of overrated over the years. Think back to post-2008, 2009 through 2016. Where were interest rates? Down at zero. And explicitly, the policy of the Fed, but central banks throughout the world, was to stimulate the economy.
Right, and what were we all talking about? Pushing on a string, right?
Exactly. That's not evidence, certainly, of effective monetary policy. Now, there are periods when monetary policy is hugely effective. Inflation and prices. Monetary policy is the driving force for inflation and prices. Liquidity crisis and banking crises. Look back to 2008, go back to the Great Depression. I think there's a strong argument that in 2008, the Fed literally saved the world. And there's a strong argument that's been made over the years, and Bernanke made this argument in a speech in 2000, that the Fed caused the Great Depression because of their missteps in monetary policy. So monetary policy with respect to money and inflation, absolutely. Monetary policy with respect to dealing with banking crises, liquidity crises, absolutely central. But monetary policy for stimulating the economy, we don't see that much in the post-2008 period. I just don't see that much evidence of it. That would be absolutely in line with the idea of rising rates in 2023 and 2024, not having a strong, effect of pulling back the economy. I'm just not convinced that during normal times, put aside financial crises, banking crises, I'm just not convinced that monetary policy has a really, really strong effect.
Chris, any thoughts on that?
I would add too that the appetite for credit changes, and so the other question you have to ask: who's doing most of the borrowing, or at least relative to history? And if you have a situation where the federal government is borrowing a lot more, and I would add municipalities to that list too, because they got trillions from the federal government during the pandemic as part of the relief, which means now they can lever back up again. Because they, even Illinois and New York, where I live, in terrible shape before, they're in pretty good shape now. And how are they responding to that? Well, how quickly can we get back into bad shape, right? So they're borrowing like crazy, and they're not rate sensitive. So almost definitionally, if you've got these big borrowers who are not rate sensitive, then obviously monetary policy won't be as effective.
Something that the Fed really focuses on is inflation expectations in their ability to bring inflation down to 2%. The intuition here is that if businesses, households believe that prices are going to go up a certain rate in the future, they're going to negotiate contracts that kind of make it a self-fulfilling prophecy. And so I think the intuition is pretty sound. But the way that the Fed and a lot of economists like to measure inflation expectations, either through the University of Michigan survey of 5 to 10 years from now, or using five-year forward break-evens from the TIPS market, in the 4 or so years after the financial crisis, five-year forward break-evens were between 2.5% and 3%. Now, in the worst of the pandemic inflation, they were between 2 and 2.5%. So to me, that illustrates that, well, maybe expectations matter on the margins, but if it really was the primary driver of inflation, we would have seen some pretty high inflation after the financial crisis, and we didn't. So, Chris, do you think we need to reassess the importance of inflation expectations in our models?
The reason inflation expectations got into the model in the first place is because the Fed was really stumped where the inflation came from in the 70s and couldn't figure it out, and here was a variable that fit. So they ran regressions, but when the regression, every paper subsequent has to include that period of the 60s and 70s, or the variable drops out as irrelevant. That's a pretty good sign that maybe its importance was exaggerated or perhaps changed. I'm not convinced that's the primary reason inflation was so bad at that time. I think it had a lot to do with Great Society and the Vietnam War, the guns and butter trade-off that we decided why not do both. And I think the low inflation, the great moderation, had a lot to do, honestly, with budget discipline and then discipline at the Fed as well.
I suppose it is difficult to have a counterfactual because the Fed, we can look at those break-evens or inflation expectations, however you want to measure them, and say, well, the Fed's credibility stopped expectations from becoming unanchored, which led to a spiral. So we don't really know what would have happened if the public writ large stopped believing the Fed's ability to bring inflation down.
Well, except that we did have that terrible inflation in 22 and 23 without a rise in expectations.
Right.
So where the heck did it come from? It wasn't expectations. It might be supply chain issues, except those were ultimately resolved. And certainly that wasn't the cause of service sector inflation, which also got pretty ugly. In fact, that's where we're still seeing some residual inflation now. So I'm skeptical, but I think part of it is, the Fed likes to project this ability that don't worry, wherever inflation came from, we can fix it.
Right.
And if it's coming from expectations, that's a more credible argument. If it's from fiscal policy, then there's not much the Fed can do.
Yeah. So I'm skeptical on the expectations as well, but from a very different perspective.
Okay.
But equally agree with you. But my perspective is, I'm afraid I don't think the Fed models are really the appropriate models for money and inflation. That the new Keynesian models used by the Fed, but used throughout the world, every central bank, and academic economists, I just don't think those models are really appropriate. And again, it goes back to this fiscal theory of the price level. Expectations are hugely important, but I think in this world, it's expectations of, we know what debt is today, we can touch that, we can see it, and we need to have expectations. We have expectations of what future tax policy will be, of what future growth will be. So those expectations are hugely important, but that's not so much expectations of inflation, it's expectations of how will the economy grow, how big will the pie be, what will fiscal policy be in terms of tax and spend.
And will Congress ever have fiscal discipline?
Will Congress ever have fiscal discipline? Those expectations, I think, are just hugely important. But I don't think those are expectations about inflation. So I'm skeptical for very different reasons.
That's a great segue to where the color of my note cards changed to more forward-looking questions, which is we've all seen these projections from the CBO, from the budget hawk think tanks, from the ones who don't seem to be so concerned about it. It seems like everyone knows that the deficit is going to spiral out of control. There's not really any move to do anything about it politically outside of some marginal politicians. And so it seems like everyone should be very aware that Treasury issuance is going to have to go up over the next 5 or 10 years. There's going to be more borrowing just to pay down the interest on the debt. But from those expectations that you would think are very obvious, why have we not seen the bond market freak out more? So right now, as we record, the 10-year Treasury yield is close to 4%. This is 100 basis points lower than it was a year ago. 4% is also pretty healthy and solid in the period before the financial crisis. It doesn't say fiscal panic. So why do you think the bond market is not showing this very dire fiscal situation if really all the projections are suggesting it?
I'm happy to start on that. And my answer is I haven't a clue. But this is actually a serious point. I mean, the debt to GDP ratio in the US is 120. In 2007, it was 65, 55, I can't remember, but much lower, rose dramatically during the financial crisis. Is 120 too high? Well, I don't know. Japan's been, way above 200, 300 for years and been pretty stable. Britain, in 1788, Britain had 182 debt to GDP ratio. And they were just on the start of, defeating France, of building a global empire. So I don't know, is 120 too high? I'm scared, but I don't know when to be scared.
Chris, just to give a little bit more context, so you talked earlier about crowding out, and I remember after the financial crisis, there were talks that the stimulus then, which was just under $800 billion, compared to $5 trillion during the pandemic, was going to cause this crowding out, was going to cause this, this debt spiral, and it looked like actually the bond market could absorb that elevated supply, and it makes me kind of take a step back and think, whenever I do see the worry about elevated Treasury issuance, do we just have a totally different concept of where that point of no return is?
Let me ask you a question. What were 10-year yields in 2019? Before all of this started, they were under 2%. So,
but that
what are 10-year yields today? They're 4%.
But that decade before the pandemic was, an unnatural kind of outlier, right?
But for a decade, at a time when fiscal discipline was pretty good, and since then we issued a tremendous amount of debt. We have, in fact, gone through a 40-year high in Fed funds, with the rest of the curve relatively high as well. So I think there has been an upward movement in interest rates. And I would add, too, that Treasury has a certain amount of flexibility in how they finance the debt. And we had a scare. 10-year note yields started to rise after there was a budget impasse. There was no debt issuance for some months, and all of a sudden they had to do $1 trillion in issuance in a short amount of time. And there was a panic, and 10-year note yields came up. And the way Treasury dealt with that was they issued a lot of bills. They kept the stuff out of the coupon market. And Yellen has made the decision to continue financing heavily in the bill market until at least after the election, which of course has nothing to do with political motivations. And honestly, it doesn't matter which party is in the White House, anybody would have played that game. But the point is that there is some manipulation that's going to go away, and I suspect that's going to put some upward pressure on yields as well. I was really nervous when you looked at Fed funds futures, and it showed the market anticipating a path of rate cuts that was much more aggressive than the Fed was actually communicating, and that extended all the way out to the end of the curve. So it wasn't just that they were going to cut faster, they were going to cut deeper than the Fed promised. Now I think the market is at least priced to where the Fed is, and I think yields are more realistic, but I think you can make a case that 10-year note yields probably ought to be closer to 4.5 than 4. Right now, we're pretty close to 4.
Right. Thomas, you've talked about how monetary policy can be effective in certain scenarios, but maybe for counter-cyclical adjustments, either stimulus or slowing the economy down, it might not be as effective. But the Fed likes to work with sort of precision in their models, right? They target 2% inflation or thereabouts, and they also have this idea of a neutral Fed funds rate, which is, according to their models, the Fed funds rate that is neither restrictive nor accommodative. Do you think the Fed needs to revisit their inflation target right now in neutral policy? Is that all a distraction from just getting crisis management and making sure that fiscal policy gets under control?
So I'm a little, as you may know, a little skeptical of some of the Fed's sort of approaches and theories. I just don't have very much confidence in the new Keynesian monetary theory that is used by the Fed and used by academic economists. Their interest rate targeting policies, I don't think is really the appropriate theory. And so, I don't have much of a view on whether they need to revise their targets. I think they need to revise the whole approach to thinking about money and inflation. But that's, this is a pretty radical approach. I'll be very straightforward. I happen to think it's the correct approach, but it's somewhat radical.
Well, Tom, I think one of the key hallmarks, right, of that all of these Fed models is assuming all else is neutral, that there's nothing outside of the model that might affect inflation or economic activity. And in fact, there's so many moving pieces right now. I think the good news is that Powell is very much a pragmatist.
Yeah.
Right? So if they start seeing things go the wrong direction, they're quick to change, and they're quick to admit they were wrong, which is, in fact, a refreshing change at the Fed from some prior leadership.
Yeah, I think having a pragmatic Fed which pays attention or it really thinks about what are market conditions, what are expectations, around a variety of factors is really a very, very powerful thing.
I have one last question before we go to the Q&A, and it's about forward guidance. And so the Fed, not only can they use their policy through Fed funds rate or the balance sheet, but also their words, their promises of policy to shape expectations. And this was really important after the financial crisis so that people knew the Fed was really, and other central banks were really committed to keeping easy policy until the recovery started to get going. Likewise, when inflation was really high, the Fed could use forward guidance to really convince people that they were going to fight inflation. And so not only does that come through in Fed speeches, but also in things like the dot plot or the summary of economic projections. Do you guys think the Fed leans too much on guidance right now? Are they boxing themselves in unnecessarily? And really, we should just approach every meeting totally unsure what the Fed is going to do?
I certainly would use less guidance than they are now. I think it's a really powerful tool when, for example, the Fed funds rate is pinned at the effective lower bound and you can promise that you're going to keep it low for a long time, but you better be certain that you want it low for a long time. The Fed has made the mistake where a couple of times in this last interest rate cycle, they got trapped into a position, for example, keeping rates low when they knew they needed to be tightening, keeping quantitative easing going when in fact they wanted to be quantitative tightening. That's a mistake. And it's a mistake that was born from keeping guidance in place too long. They should have lifted it earlier. And honestly, when you're in a situation where the Fed funds rate is relatively high, where there's a lot of flexibility, they could tighten, of course, to slow the economy. There's plenty of room to ease. They shouldn't be using it at all. And I think this idea that they have to set up market expectations before every meeting, huge mistake.
Any thoughts?
So I think the issue of forward guidance is really an interesting one. But I think it brings in, and you've raised this point a couple of times, about fiscal policy. Mm-hmm. And I think the coordination between fiscal and monetary policy. And I think this is the one really important point from these new ideas in monetary theory is that it's the coordination between fiscal and monetary policy which is important. And so simply having forward guidance from the Fed without thinking about what is the forward guidance or what have we, expectations of fiscal policy going forward. You've mentioned a couple of times the issues of Congress. And so I think tying those two together, the monetary and the fiscal, and thinking about the Fed is trying to just work only on monetary policy, whereas I think the world works with the combination of monetary and fiscal.
Yeah, two policy levers, and if you're going to use them both, they have to interact. It makes sense.
Yeah, it makes perfect sense.
Well, thanks to both of you. Happy to open up the floor to Q&A if anyone has any questions. Bill has a microphone here that he can give to you.
Emily has one too.
Where do you think the 10-year yield will be a year from now?
Yes, what is the 10-year yield going to be in a year? I'm just the moderator here, so.
I think the market right now is priced for what the Fed says it is going to do, which would be cut another half point this year and a full point next year. And if they actually stick to that schedule, then it makes sense to think that the 10-year note yield is going to be around 4%. We're hearing a range of possibilities from members of the Open Market Committee in response, by the way, to one employment report, where all of a sudden, for example, Raphael Bostic saying, I might be happy easing just once at the two remaining meetings this year. If that happens, then a higher rate. And I think, in fact, the really material point we need to be focused on as investors is sort of 3 to 6 months down the road, where whatever rate cuts we get stabilize the job market, the unemployment rate is no longer rising, and at that point they're going to swivel back and look at inflation. Now, all the rhetoric from the Fed right now is that inflation is coming down and it looks great, but if you actually look at the core inflation rate, it's unchanged in the last 5-6 months. It's been stuck. It has to continue coming down. If it doesn't, then that's a perfect scenario for pausing in rate cuts, in which case all of those coupon yields have to adjust higher as well.
So I'll say I haven't a clue where the 10-year will go, but that's fortunately not my job as now that I'm in academics. But I think it's actually important that there's a huge amount of uncertainty about the future trajectory of rates, inflation, even growth. And part of that really massive uncertainty has to do with this issue of fiscal policy and the current debt and deficits. How is because it's certainly not going to happen until after the election, but how are we as a nation going to address these issues? I think if they're not addressed, right, the CBO projections are pretty dire.
I think Tom's point is that one way to illustrate this is if you go back to the early 80s all the way through the mid 90s, in every poll of voters, top 1 or 2 issue was the debt and deficit. And the reason is not that it was worse than it is today. It was actually a lot better than it is today. The reason is that the government was determined to balance the budget. And so every election we were faced with a choice: tax hikes or spending cuts, or some mix of the two. The pain comes when you start addressing it. And the fact is, at some point, you're going to have to address it. And it will be more painful this time.
And the fact is, at some point, you have to address it. And also, at some point, investors, both domestic and foreign, are going to lose confidence. Not that they will lose confidence, but there's a risk. And you see that in developing nations where suddenly there's a flight from those currencies and that debt. And I think there's a risk of that at the US. I don't think it's a big risk, but that's a huge uncertainty because we don't have any idea what level of debt to GDP that would be. We don't know. There's just so much uncertainty in that. So I think trying to make projections about the 10-year a year from now face that problem of this really radical uncertainty when and whether investors, the world, domestic, will start to worry about that. I don't know whether they will or not.
Yep, question, yes.
Real quick. So, Chris, based on what you said, 6 to 12 month horizon, is it fair to say that you've got a steepener on?
Yeah, in this, look, it was a lot easier to say when the 10-year note was flirting with 350 than it is now at 4. But I think it's really important to recognize, right, that when the Fed is done, you should have a normal shaped curve at that point, as long as there's no significant no significant recession fear. You should have a normal shaped curve. So how do you get back to a normal shaped curve? Well, the Fed is going to do what they're going to do. Right now they're saying Fed funds a little below 3, which means, maybe 10-year note yields at 4% make perfect sense. But if they can't go that low, if they can only get to 3.5, or if they can only get to 4, well, then we've got to have a higher 10-year note yield. And this is like every other cycle in the 40 years or so that I've been doing this, the one given, it's not going to be like the last cycle. There's always this uncertainty. And the Fed talks about it in terms of trying to figure out where the neutral funds rate is. That is, where is it appropriate to stop cutting? They have an estimate, And every time they talk about it, they point out, we're not sure how good that is. We don't have a lot of confidence in that. It's a good indicator that they're going to be feeling it out, and they'll make decisions as they get closer.
Do we have another question back there?
So I think very much this idea of the interaction between fiscal and monetary policy is very appropriate, and very interesting interchange between the two of you on it. The fear that central banks will inflate away the debt, of course, goes back quite a long way. Lots of research on the independence of central banks. I wonder if the fiscal theory of the price level has a different view of how the debt causes the inflation than the older theories, and if you can wrap this in, inflation has come down a lot, and none of us have seen a wave of fiscal prudence crash across the economy. So a little more. I love the way you're coming at this. I'm just looking for a little more detail.
So let me address first that second part. Inflation has come down without fiscal prudence, and that is true. But what happened? We had a surge. A sort of a lump of inflation of debt, which came into the economy. That needed to be inflated away, so you needed to have prices go up. But once they went up, we don't have a continuing surge of debt coming into the economy. So prices went up, they inflated away that debt, they kind of stabilized. But what does that mean? That means inflation goes up and then comes down. Prices are now at a higher level. It's done what they needed to do. So I think that's makes a lot of sense. It's focusing on total liabilities of the government, and it's thinking about the balance between those liabilities versus what makes them valuable. Why does any of us buy government bonds? We buy government bonds because we're going to get coupons in the future. But what's the real value of those coupons? It depends on how much the government can extract in real resources out of the economy. That depends on taxes versus spending. And so if the debt goes way up and our expectations of the government's willingness and ability to pay that back in real terms, if both of them go up, it's going to be kind of a wash. What happens is, what if this debt goes up and the liabilities could be either money or bonds? What if those liabilities go up and there's not much expectation that this future payback increases? Well, then you got to have this real value coming back down, and the only way to have that happen is inflation. So it's tied in with this idea of printing money, but it's a little broader because it's thinking about overall liabilities.
Well, and so also it seems, right, that you don't have a conscious decision by the Fed. We've got to cause inflation to make the debt more manageable. It's actually the debt itself causing the inflation.
Well, it's the debt. It's you and me and all of us as investors deciding, you know what? I don't want to hold so many bonds. I'm going to sell the bonds so I can go out and buy things, services, goods.
Right.
That's going to cause inflation. That's kind of the mechanism that if we all collectively decide that we have too much bonds or bonds plus money, we're going to try to get rid of it. How are we going to get rid of it? We're going to try to buy goods and services. That's inflation.
And of course, that was part of what we saw in the pandemic, this saving.
That was exactly what we saw. We all had money put into our bank accounts, and very, very reasonably, we all went out and spent.
We've got time for one more question. I actually have one that someone sent in if we don't have any more from the crowd. This is from a very loyal listener. What do you think is the biggest threat to maintaining the soft landing? And I think it's just important to put into context that, yes, the unemployment rate in the last report ticked down to 4.051%, but the unemployment rate, inflation, it feels like each report we could be teetering on the edge of prices accelerating again or the labor market deteriorating. So we're kind of in that soft landing scenario right now, but it feels like every month we could be at risk. So what do you in the next 12 months, what do you fear jeopardizes that the most?
I look, two things, right? Because a soft landing is achieving your inflation target without having a recession. I think the recession side, we're pretty safe on that. We've got decent job growth still. The unemployment rate has come down the last couple of months. we continue to set records in retail spending and so on. The economy is bubbling along at 3%. I mean, doesn't look very recessionary. I'm more worried about the inflation side. And again, inflation, while it has come down a lot, the pace at which it's coming down has slowed a lot. And in fact, most of the inflation improvement in the last year can be traced to the weakness of the Chinese economy, the fact they're buying less oil. And we've had, in the last year, energy prices have fallen more months than they've risen. But if this Chinese fiscal stimulus works, if they start buying up oil again, then I think that's your risk. The big risk is on the inflation side.
Any thoughts?
I would say also the big risk is on the inflation side. I would agree with you there. And again, I step back and look at a longer term perspective. I think that inflation risk is driven by expectations over future fiscal policy and whether, fiscal restraint can, in one way or another, whether we can.
Look who's running for president, right? Neither one of these candidates have fiscal responsibility at the top of their list.
So on these issues of solving these fiscal issues, I'm an optimist. But boy, I'm very sympathetic to any pessimistic argument.
Well, on that note, thank you, Thomas Coleman, Chris Lowe. Thanks to all of you for coming to our first live recording of Simply Put.
That was Chris Lowe and Thomas Coleman. As unusual as the circumstances were during the last 4 years, I think pandemic disruptions and the huge amount of stimulus are important reality checks for the reliability of most economic models. Supply-side issues and fiscal expansion have not been common over the last 4 decades, leaving many policymakers flat-footed in terms of understanding the impacts on a rapidly changing economy. The next cycle will be different because it always is, but the Fed will try to refine its models in order to better gauge effective monetary policy in the dynamics of the macroeconomy. Next Tuesday's elections are the big macro event over the next 2 weeks. Forecasting models suggest the race for the White House is a toss-up, the House is likely to go to whichever party wins the presidency, and the Senate will shift to Republican control. Because there's a good chance the election is not decided the evening of November 5th, the bond market will show elevated volatility as the results are reported and investors try to position for the perceived electoral outcome. The Fed will meet the next day and announce its latest policy announcement the day after that. Fed funds futures are suggesting the market expects a 25 basis point rate cut with a high degree of confidence. The FOMC statement and press conference will prime markets for what to expect in December onward. We do not foresee the election factoring into the Fed's decision next Thursday. The following week, October CPI and retail sales will give the first important snapshots of Q4 inflation and household spending. Extreme weather events may have impacted economic behavior in October, so it's difficult to know how the Fed and the bond market will view any big surprises in those reports. That's all for today's episode. Thanks again for listening. I'm Will Compernell, macro strategist with FHN Financial. This episode was edited by Bill Stanfield. Don't forget to like and subscribe to Simply Put wherever you get your podcasts. Email simplyput@fhnfinancial.com with any questions or comments. This podcast is presented for informational purposes only and is not intended as an offer or solicitation with respect to the purchase or sale of any security. Views expressed herein accurately reflect the speaker's personal views about the data, news, trends, events, etc. discussed herein or any subject securities or issuers. No part of their compensation was, is, or will be, directly or indirectly, related to any specific recommendations or views expressed. FHN Financial, through First Horizon Bank or its affiliates, offers investment products and services. Investment products are not FDIC insured, have no bank guarantee, and may lose value.